All right, well, let's go ahead and get started. This is being recorded, so for anybody who comes in late, you can always catch the first part of it. This likely will not take an hour, which kind of depends upon how many questions we get and how much feedback we have. So I wanted to make all of our Art of Homeownership partners aware of an opportunity that we were able to take advantage of as a team a little over a year ago. I want to say maybe about a year and a half. I'm not sure what the exact date is. Rich, maybe you could tell me how long we've been in the agency, but now, one of the things that we've always looked at was how can we provide a higher level service to the client? How can we stand out in terms of ongoing value? And then because the mortgage industry typically has not been the mortgage or real estate business, there's no long-term revenue stream, there's no annuitization, there's no real, the growth until, what we've built at Art of Homeownership. Now we believe that we can accomplish that. But, the insurance business has always been appealing because, you can grow a practice that continues to pay you over time. And then the value of that practice grows as your book value grows. And so, we were approached by Comma Insurance, a good friend of mine kind of helped start the agency, and they have a franchise model. And, we entered into agreement with them where we can kind of help them, bring more people into the organization and, allow more real estate agents and more mortgage professionals to participate in the insurance side of the business, and also to add an additional layer of service and value to the consumer. So from our perspective, the reason why we really loved it was because we can talk to a client and say, hey, we also have a division of our company, and we obviously have an affiliated business agreement that shows that we have ownership in it. But our insurance company is called Comma Insurance, and we have a really great insurance professional. The guy who works on our team, his name is Sky, and we operate differently in that channel as well, right? Most insurance companies are going to give you the bare minimum, cheapest insurance just to earn your business. We'll show you that as an option, and we'll also tell you why that may not be the most appropriate option. And so it just really falls in line with the Art of Homeownership premise, right? Which is, we're not the cheapest, but we are the most valuable, and we will make you and save you more money over the next 10, 20, 30 years than any other mortgage or real estate professional in the market. And if we have an insurance arm that can help promote that as well, and that we can also, really build into that fold, then it just becomes all the more valuable, right? And if we do this well, again, we create dependency from every aspect of real estate or finance. And so, what we can tell them is our insurance specialist will really analyze your situation and not just tell you the insurance you can get, but the insurance you should get. And we'll be really clear on why. We'll show you the cheapest option, we'll show you the most expensive option, we'll show you everything in between. Very similar to the mortgage space, very similar to the real estate space, right? Like, we're not going to say that this is for you just because we believe we can sell it the best. And most people are underinsured. Most people, pay the bare minimum for insurance, and then when something happens, they wish they hadn't. So it's just an additional reason why they can trust us. It's an additional layer as to why they can be, really committed to our team, because we have yet another resource for that. And so, for a long time, we would refer our insurance business out to a local agent, right? Somebody who would come by and drop off cookies or donuts or, whatever they can do to kind of keep us happy. And the lifetime value of an insurance client is anywhere from $4,000 to $6,000. And so essentially every time you're referring out to an insurance agent, you're kind of writing a $5,000 check that goes along with it. And so we said, look, if there's a way that we can own the insurance practice and train the insurance professional to operate like we do and be very like-minded in terms of doing the right thing by the client, making sure they're insured appropriately, making sure that every year when their renewal comes up, we do a thorough analysis of what's changed in their life, what's new, are we overinsured, are we underinsured, what's changed. Obviously, there's a lot changing in the world today, and we have fires in California and floods and damage and stuff. So insurance is always an evolving thing, and it needs to be constantly monitored. A lot of people just have insurance policies they keep in place. They renew every year, and they never know that they're paying way more for insurance than they need to. So that's yet another feather in your cap to say, we're not only going to manage your mortgage, but we can manage your insurance, we can manage your real estate, we can really ensure that we're proactively helping you in many different aspects of real estate or finance. So when we came across Comma, the the idea was, okay, well, how do we accomplish this? How do we make it compliant? And so essentially what they've done is they franchised the insurance practice. And so it takes about 250 closed transactions per year to really make it a viable insurance practice. The more, the better, right? And you may be thinking, well, I don't do 250 deals a year, and you don't have to. What we did in my group is we split it up between myself and we have 7 other originators that are in the company with us. So all 7 of us actually own the insurance practice, and we all contributed to the startup costs. So it limited the cost. It wasn't just one person, and so collectively we're kind of all in this insurance business together, and we're all driving all of our clients into one channel. And so with us, I think we're probably close to maybe 1,000, 1,000 or maybe 1,500 now in terms of transactions per year. And so the market value of your practice goes up faster, and then the book value goes up faster the more clients you have in there. So I wanted to just kind of go over what the pro forma looks like a little bit. Maybe Rich can touch on some things that I left out. But the goal here is twofold. 1, be more valuable to your client. 2, be able to earn kind of a long-term additional revenue stream off of your business and not just hand that over to somebody. And also control the service, control the experience, because when you start your insurance practice, Comma really does everything for you. They've been amazing. And so, not only will they help you get your business filed and started, they'll help you hire your insurance agent. They'll train that insurance agent. They meet with you consistently. They give you reports. They help you understand how to, connect better with clients in terms of, getting a better conversion rate. So it's really something that, if you think about starting an insurance practice, you think, oh my goodness, there's no way I have time to do that, right? All of our hair is on fire right now. Most of us don't even have time to do all the things that Art of Homeownership can do, much less start yet another business. I want you to know it's not that challenging. It's really just more, the upfront financial investment. Comma does a lot of the heavy lifting for you. You do a few things here and there, and all of a sudden you start referring in, your clients start getting insurance through your own practice. All of us have our own insurance through the practice, right? So every time we pay our insurance, we're technically paying ourselves, which is nice. And then the insurance agent that you hire, they're supposed to get a good amount of business from you, but they're also supposed to get their own business as well. So they're incentivized to go find business on their own. And essentially you can help anybody. My neighbor the other day, he didn't need a loan, but he asked a question about insurance. So we put him in touch with our insurance team and we helped him. So it's a really great opportunity. And I wanted to make sure that everybody knew about it. Let's see, we have a chat here. So I'm sure we'll get to it, but interested to hear about the compliance implications. Yeah, I can touch on those now. So depending upon the company you're at, your company is going to have a different level of comfort when it comes to the compliance of this. It is 1,000,000% compliant. As long as you have an affiliated business agreement that goes out with your disclosures that says that you are, you're part owner in this insurance company. It's been vetted out by the top compliance specialists. Now, some companies may just not want to deal with that because if they do it for one person, then they have to do it for everybody. So there are some companies where maybe you put it in your spouse's name, so they technically own the insurance practice, and then you're referring business that way. So it just totally depends upon how comfortable your mortgage company is with the compliance aspect of it. If they look at it, they'll say, yes, this is 100% compliant. There's nothing wrong with this, but they might say, well, but if we do it for you, then we have to do it for everybody. And then it just buries our compliance team. So put it in your wife's name, put it in your husband's name, spouse's name of some sort. And then they just aren't really too concerned with it. But it is totally compliant. There's, Rich, I don't know how many mortgage practices you guys have signed up. I know that we've referred quite a few, and but maybe you can touch on the compliance piece as well.
Sure. Yeah, happy to do that. So now, Ryan,
yeah, go ahead.
Yeah. So, by the way, good job, Ryan. That was really thorough. We ought to just shut it down. No. So pertaining to compliance, great question. Our company spent over a year and a couple $100,000 with people like Mitch Kiter in Washington, D.C. and other compliance lawyers to make sure that before we launched this business, that it was lily white, above board, no gray area, because we only work with high producing loan officers. Our business is 100% focused on working with high producing loan officers, and none of you want to risk your day job or any sort of legal issues around some side hustle or side business. And so we spent a ton of money and a ton of time to build this thing so it is absolutely compliant. Ryan's right. We've met with compliance folks from a number of the largest mortgage companies in the country, and not a single one has said, "Oh, this isn't legal." Not only that, but a lot of our loan officers collect the ABA sign, but we make sure that our producers, our insurance producers, catch 100% of the ABAs, get them signed. So many cases the client signs it twice, but we certainly don't want them to slip through the process and not sign at least one affiliated business agreement. So, and then, when we created it, we never dreamed that loan officers would potentially put this in other people's names, but we see it in the name of trust. We see it in spouses' names. Still, the vast majority put it in their own name, but as Ryan said, some people just want to sleep better knowing that it's literally not in their name, and that's fine with us.
Yeah. Wade asked the question, how do you weave this in with the annual mortgage review process? So this is a big component of it. It's just every time we have that process, we go, hey, did you connect with Sky? Want to make sure that you're getting your renewals in place. Or if they didn't end up getting insurance through us in the beginning, we'll offer it. And again, it's on purchases, it's on refinances, it's on annual financial reviews, it's on, so every single time we're connecting with the client, we always want to make sure, hey, insurance is always changing. Our commitment to you is to help you in every aspect of real estate or finance. We wouldn't be doing our job if we didn't have this analyzed. I see here you have your insurance with USAA or whomever. Are you okay if we just have it analyzed for you? No harm, no foul. If it comes back and it's good, we'll tell you it's good. And then you just at least, that you're in a good spot there. So it's a really cool component. Again, it's just yet another value add and another reason for the client to say, man, these guys just always have my best interest in mind. They're always doing the right things for me. And, they're just going the extra mile. So yeah, let's get into the kind of the startup cost, if you don't mind, Rich, and maybe the pro forma modeling, if you want to share your screen there. So guys, typically the cost to start an insurance agency, the startup cost to, do licensing, infrastructure, set up your business, hire your agent, train your agent, do all that stuff. It's $100,000 is the startup cost. We've created a discount through Art of Homeownership where you'd save $20,000 off of that cost. So as an Art of Homeownership partner, it would be an $80,000 cost. So if you're a 300 unit a year originator, you could take that on yourself. If you're a 100 unit a year originator, 50 unit a year originator, you could find or partner up with other Art of Homeownership partners or even other loan officers that you may have in your branch, other people you may have in your company. And, you can have 10 people that each put in maybe $8,000. And you guys can split it that way. You can all put the revenue in. And so, Rich, if you want to go through the pro forma and kind of talk about break even and long-term growth and what that looks like.
Sure. Yeah, happy to do that. So a couple of comments I'd make before I jump into that. So Ryan talked about the startup cost. The partners of Art of Homeownership, that's our target audience. So it makes great sense for us to be talking to you. If this business model is of interest to you, you want to kick the tires, let me know and we'll set up an individual conversation. But just as important as startup cost is startup time commitment. And Ryan was mentioning that a minute ago. We, once again, have built our business around working with high producing loan officers. So it really starts when you say, yeah, I'm interested in this. What I like to tell people is my goal from your commitment, your time from when you say that versus when we have the branch open should be less time than it takes you to play a round of golf. So it really is, we set up your LLC with us, we set up your bank accounts, everything, your commitment from a time perspective is really around DocuSign stuff. So all of our agreements are standard agreements. We welcome everybody to bounce them off lawyers, do what you want, but they're standard and we rarely modify them at all because, as I said, they've been built around compliance, Mitch Kiter in Washington, D.C., RESPA, compliance, et cetera. So anyway, I'll share the pro forma here, but let's jump into this. All right. So this model that I'm sharing with you is a conservative model. It doesn't have any escalators or accelerators. So if you're doing, let's say, 300 transactions this year, but you expect to do 350 or 400 next year, it doesn't take any of that into account. It is intended to be conservative so that if you choose to join us and do this, and a year from now you're happy, and 2 years from now you're really happy. We've overachieved the model that we put together for you, and not, you don't call me in 6 months or 12 months or 24 months and say, hey, Rich, this thing's not playing out like you said. We've done our part, but you haven't done your part. Our business model here only makes sense if you and I, if we're working together for many years to come. The illustration, and I'm going to try not to get too bogged down in the numbers. I think most of this will be good for us to talk about later for those that are interested. But for every policy that your agent, your producer sells, you get 90 cents on the dollar of all first year commissions. So we get 10 cents in year one, and then we get about 45 cents per dollar in years 2 and on out. But I hope that illustrates that we're in this for the long term, certainly not for some agency setup fee or 10 cents on the dollar in commissions. Before I get too much into this model, I know that everybody that's on this call and part of Art of Home Ownership has a really high level of customer service and driving for an incredible customer experience. Our business model totally supports that. When you all make the referral, like Ryan was talking about, and by the way, prior to COVID, a lot of those referrals were verbal. A lot of them now are just an email to the insurance producer and to your client saying, hey, want to introduce you to each other. Want to make sure, Mr. Client, that you have the very best options available to you for insurance. Here's a producer that we work with who has 15 carriers. We actually are over 20 carriers now that we have access, direct relationships with. So we can shop everybody's business, whether they have pit bulls, trampolines, swimming pools with diving boards, all kinds of crazy stuff. We can shop everybody with multiple carriers and find them incredible deals. That's not the case with State Farm or Farmers. Those are called captive agents. They have, one carrier they can work with. So having said that, let me jump into this. So you can see the cash requirement here of $80,000 that Ryan mentioned. 30,000 of that is an onboarding fee to us, helps us offset legal fees. We immediately start recruiting and interviewing and assessing producer candidates for you if this is something you ever want to jump into. So there's a fair amount of cost involved. We also have centralized all the back office functions. So if you were to choose to do this like Ryan and his team did, they have 1 or 2 producer employees, and that's it. Everything else, customer service, HR, IT support, all that stuff is all centralized at our headquarters in Oklahoma City. So what it does is it allows you to own a business that is extremely lean. You literally have your 1 or 2 employees, and that's it. Everything else is part of our sort of centralized overhead. The good news there is your producer, unlike most other agents in your town, once another agent in your town, once they start getting some business a year or 2 in, the phone's ringing, they're having to answer those phones, and all of a sudden they're taking time away from selling. In this case, once your agent sells a policy, we move that policy over to an account management person on our team who is a licensed agent in your state, and that allows your producer just to continue to sell and work the referrals that you send over. We have a commitment to get back with every referral within 24 hours. And if we at all can, we get back with them same day. So when you're saying, hey, I want you to talk to Rich over at Comma Insurance, and an hour later I call, the customer's delighted. They say, oh yeah, Ryan told me you'd be calling to help me with my insurance situation. And that's how the conversation starts, and it goes from there. So we are all about developing great relationships, just as you all are with your clients. And, Ryan alluded to it in this business model. Unlike the loan officer business or the mortgage business, you make a loan, you close a loan, you make a chunk of change, and you move on down the line. In insurance, you build that residual, you'll see here in a minute, very significant residual income, because you get the same commission a month. If I sell a policy today, I'll get a commission next month for that. A year from now, when that client renews their policy, you get that same commission. And then 2 years from now, that same commission. And so you can imagine how, you start piling up hundreds and hundreds of policies every year. And this model I'll show you here in a second illustrates that. So the $80,000 is comprised of two components. One is the agency onboarding fee, and the main component, the $50,000 remaining, is actually it goes into your operating account. So that's what pays for your producer, which you can see down here on row 10. We pay a base salary essentially of $2,000 a month, and everything else they earn is commission. In the first year, the average income of an average producer for us is around $60,000 in the first year. So if they make $24,000 in base, they've got that remaining portion coming through them in commission. And because of that renewal commission component, second year they jump up to around $70,000, $80,000, and in the third year I want them tapping at about $100,000. So once we can get them to stay that long, they generally stay a long time with us. But all that to say, the $80,000 comprised a $50,000 startup fee and a $30,000 agent onboarding fee. And by the way, Ryan, your team's been with us a little bit over a year now. And all of our branch offices, once they've made this investment and started their operating account with that $50,000, we haven't had to go back to any of the owners and say, hey, the account's dry, you need to make more contributions. The commissions start coming in the month after we open your branch, and every month we're making sales, and every month commissions are building and they're offsetting costs. So that's a key component to this model. Everything else in here, I'm not going to go line item, but I'm happy to share this with any or all of you after this call or walk you through it again. Everything in this model is a direct pass-through. There are no, I've had loan officers ask me, well, where do you make money in this? Where are you grossing things up? Everything's a pass-through. If something costs us, so for example, you see $1,250 a month in rent here. I don't think we have a single producer that we pay $1,250 a month for an office that we rent them. Usually they're around $400, $500, $600, but we put $1,250 in the model. Of course, if it costs $500, when we get a producer and we put them in an office, then that number is $500. It's not $1,250. So there are no profit centers built into this model. The key components to pay attention to and what really drives this, and the reason Ryan said, we target loan officers and loan officer teams that do a minimum of 250 transactions a year, is that's basically what it takes to keep one producer pretty busy. This model you'll see in a minute, I think is pretty exciting and kicks off some really nice profits to you, and obviously builds a business that serves your clients in a way that they probably haven't been served by their insurance producers in the past. But if you start getting less than 20, 25 transactions a month, you've got a producer who's spending too much time working their personal business, and the return is just not as exciting as numbers that are higher than that. And of course, there is no ceiling. So Ryan's team is ready to have their second producer a year in, and so we'll probably start looking for that person pretty quickly. And we've got other branch that has as many as 4 producers on staff, and that just has to do with great loan officer referral volume. And then you see here non-owner referrals to the producer. We actually train all of our insurance producers to go outside of just their loan officers and establish relationships with other loan officers, home builders, inspectors, realtors, and bring in about 1 or 2 policies per week from outside sources. They get paid at a little higher commission rate on that, and it really helps grow your business nicely economically.
Hey, Rich, there was a question from Mike that says, is the 30,000 part of the 80,000 startup or addition to it? Can you scroll up? I'm not sure what 30,000 he was referring to.
Yeah, it's right here, the agent onboard. So yes, the total investment all in is $80,000. 30,000 of it is the onboarding fee, and the other 50,000 is actually just it goes into your operating account to start your business. So that should answer that.
Cool, thank you.
Yep. So let's see, we're talking about the referrals down here. So this model in rough numbers, just to make sure everybody understands, if Ryan refers 10 folks to me, and we've been in business 7 years, so a little over 7 years. So historically, our numbers are a little higher than this, but if you refer 10 to me, I'm going to talk to 8. So 2 people just aren't going to return my emails and my calls. They've got, insurance agent that they really like, or a friend or a family member or something like that. For whatever reason, they're not going to return my call. I'm going to talk to 8 out of 10. And of those 8, I'm going to sell about 35%. So about 4 of those folks, a little less than 4 out of the 10 I'm going to sell. And we've got branches that certainly do better than that. But like I said, for this model, we want to be very conservative. We want to overachieve these numbers for our partners that choose to move forward. And then you see on the outside business that the producer, sources themselves, they typically close about 40% of the people they talk to. The other thing that's really important about the insurance business is across the country, agency retention is running about 81, 82%. We actually are running 93%, but to what Ryan said earlier, we're working, our partners are all high producing loan officers like you all. And so we take very seriously this commitment to a higher level of service. And like Ryan said, we're calling our clients proactively a couple of times a year. We are not that company that if they have a question or a claim, they never get a call back, they can't get a live person. We are super high touch. And that's how you go from 80 to a 93% agency retention rate. And just those 10 points in between the industry and where we are, that's hundreds of thousands of dollars of value over the lifetime for each of our branch offices. And once again, your producer's making the sale, they hand that over to our account management folks, and it's our account management folks' job to really lock in that relationship, make those customers happy, really delight them. Obviously, we're calling them, we're making sure they're happy, we're checking to see have they bought a new home, have they bought a new rent home, weekend home, motorcycle, RV, all that kind of stuff, because all of that needs to be part of their insurance portfolio. Now, I'm in the Midwest in Oklahoma City, and the numbers I have here for the average home premium and auto premium are typical for us here. Your numbers, and I'm sure we have folks in virtually every state on this call, may be a little bit higher or lower. So, if you'd like one of these times if I talk to you individually, we can certainly modify that. It impacts the numbers that we're about to look at, but it doesn't impact them as much as you would think. If there are no more questions, I'm going to jump over because those are really the key components. And I put in here the referral number. I put in 40 a month. We can move that to 25 and we can move it up to 100, but 40 is sort of an average for the groups that we partner with. And if I go over here to the summary slide, so what this tells you is that in year 1, you put in $80,000 and you made back roughly $40,000, but you're still $40,000 in the hole. Doesn't mean you have to add money to the account. The business is running fine. It just means that we didn't recover all of your $80,000 investment in commissions because we had expensive in commissions, but you got half of it back in year 1. What's really exciting is in year 2, you've turned a profit. You've got $51,000 net of all expenses to distribute to the owners. So whether it's one loan officer or a group like Ryan's, you've got 50 grand in year 2 to distribute. And I'm just going to skip over here. You see in year 5, and these are not cumulative. These are each year. So year 2, you got 50 grand. Year 3, it's 91, 125 in year 4, 187,000 in year 5 to distribute. And you can see it just grows from there. But before I move on, I want to point out one thing. One difference with the loan officer business, and I talk to loan officers and they say, someday I'm going to want to do something else or retire, but I'm just going to have to walk away from this business. There's really no value to selling it. And that may be true for loan officers, but insurance is very different because you've built a business. And by the way, this is a business, once again, as Ryan said, that you own or you and your partners own 100% of. We're just your operating partner. Our focus is to build this such that all you do differently than what you do today is you just pivot from making your referrals to whomever you make them to today to making them to your own insurance agency. We do everything else. We have a lot of reports that we email you. If you're interested, we have some loan officer partners who are really into the reports and look at them every week and every 2 weeks. And we have some that just hit the delete button or file them in an email cabinet, and they just care about when their next distribution check is coming. And that's fine too. But the goal is we don't want you to take your eye off the ball. Once in a while, I talk to a loan officer and they'll say, you know what, I've been interested in insurance for a long time. I'm excited to talk to you about, starting an insurance agency, and I look forward to noodling around in the insurance agency. And I say, you know what, that's fantastic, but this isn't the model for you. This is the model for loan officers who want to do loans and just keep pounding out loans and taking care of your clients in the areas that you're familiar with, and not take away 2 hours, 4 hours, 6 hours a week because you have ownership in an insurance agency. We're your operating partner that does everything from recruiting and hiring and training and managing your producer and everything else that I've mentioned. So having said that, this line 13 on this valuation, even at the end of year one, where you've only recouped half of your investment, you've got an asset that if you wanted to, you can sell it for $170,000 conservatively. In fact, in our agreement with you, by the way, this branch, this insurance agency is yours and you own 100% of it, but we have a standing offer in our contract with you that says if you ever want to just tap out, we'll buy it from you for this price at 1.5 times the annual revenue. So once again, not that I would encourage you to do it, but if at the end of year one you said, Rich, I think you're a jerk, I don't like working with you guys, write me a check for 170 grand, we would do that for you. And you can see how that number grows significantly. So at year 5, let me just slide down here a little bit. So in 5 years in this model, you've taken out $469,000 in distributions. And at the end of 5 years, if you wanted to, you could sell the branch. We would buy it from you for $846,000. And I can tell you, with the cost of money today, where interest rates are, this 1.5x valuation is low. I'm seeing agencies, not ours, but we also buy agencies that are selling for 2.5 to 3.5 times. So that number could easily be 1.5 million or more. But after 5 years, you put $80,000 into something, and if you wanted to just tap out, you could have 1.3 million. And if I scroll down, it gives me, a really healthy, I guess it's up here, 1,645% return on your investment, which probably beats just about anything else in your portfolio. And then very exciting if you look at 10 years. And once again, all you've done differently is just shifted where you're making your referrals. In 10 years, you're cashing an annual, a check for $411,000 that year, and you've got an asset worth $1.7 million for a 4,711% return on your investment. So this summarizes down here. You've taken $2 million out after 10 years. You've got another an asset worth 1.7. So after 10 years, if you wanted to tap out conservatively, you'd have $3.7 million from an $80,000 investment. So I'll pause for a minute, Ryan. That's those are the highlights of this thing. I'm happy to answer any questions or model any other numbers.
Yeah, that's great. Thank you for going through that. And guys, just, obviously these numbers get really attractive as the years go on. And, a lot of us have been doing this. I wish I would have started this, in 2011 when I started in the business, because, I'd be square in the middle of year 10 right now with a, almost a $2 million valued asset, and would have made a lot of revenue along the way. So it's never too late to start, right? Unless you're planning on doing this for another year and shutting it down. But this is all part of the model. And it also is a big part of your plan to transition out of the industry, or out of the business at some point. So this is where, when you're thinking through your transition planning, or, being able to turn your mortgage practice or your real estate practice over to somebody, having this being a carrot that they could potentially earn into or be a part of, or potentially buy from you, is just yet another great strategy here. So let's go through a couple of questions here we're getting. One is, have we ever done this where we bring in a current producer as an owner, and then how would that affect the numbers? So I asked this question originally as well. Typically a current producer is going to have, depending upon if they own their insurance practice or not, it wouldn't really pencil out for them. So in this model, and Rich, you can kind of back me up here, or correct me if I'm off base, but we kind of look for people that have, are somewhat newer in the business. Maybe they've been in it for 2 or 3 years. They're good at doing insurance. They're just not great at going and finding business. So this gives them a better platform. It's just a bit of a challenge to fit someone who maybe already runs an insurance business into this model, because they wouldn't own any of the business. They're just an employee of the business. Rich, do you want to shed any light on that?
Yeah, so exactly right. So there's a couple things. About 20% of our producers that we hire come to us with experience. It's rare, but it happens. So for example, Ryan, your guy, Sky, he worked for a family agency for like 9 years, and then his aunt sold their insurance business, and he found us, and it was a great landing spot for him. But if somebody is out there and they're an active, super high producing insurance agent, they're probably making significantly more money than this model has in it. Now, look, this is a business that you own. And if you've got a friend or somebody you think is dynamite and they're going to bring a book of business and grow this for you, then you can say, hey, Rich, I've got somebody, we've had this happen one time. We've got somebody we want to put in this role. Let's just put them in it, and they modify, instead of paying a $2,000 base salary, they change it. Or if they want a different commission split, they change it. It's your business. But this model that I'm showing you here represents 90% of our branches, and we do a really nice job with finding people who are at a great place in their career to become licensed insurance agents. We work with them to get them licensed, and then we give them 5 days of in-person training in Oklahoma City, and then we have a ton of support. I had a sales meeting earlier today with all of our producers on it. We have lots of support for our producers all over the country. So we do successfully take people that have no experience in insurance, and after a week of in-person training, they're selling policies, they're taking referrals from you all, and they're building your business, and this compensation structure works for them. But we have made exceptions, and once again, it's your business, you own it, and you can make that call if that's something you want to do. The only thing I would add, and I get questions from a lot of loan officers, is, well, Rich, what kind of people do I look for partners? Whether it's an insurance agent, which would be very rare, or other loan officers, this whole business is built on referrals. So you just want to make sure that if you're going to have partners, you're partnering with people that are going to refer business for the foreseeable future.
Yeah, that's great. Next is, does the customer service team notify the loan officer if a different lender requests a change to the mortgagee clause? Is there anything, I don't even know if I've asked that question, Rich, in terms of the renewal team, or if someone gets a change request for mortgagee clause, are they notifying us as the originating team or the referral?
You know what? I'm going to have to find out. That's a really good question. I'll find out.
Yeah, if they can, that'd be awesome. It'd be kind of a portfolio retention strategy. So that's a good question, Wade. We will find that out and get the answer. And then Mike's asking here, what are the licensing implications or benefits if we lend in 30 states? So how does that work? Because I know, primarily someone will get licensed in one state, but how do they leverage agents in other states, or do they get multiple producer licenses? How does that work?
Yeah, so great question. Actually hear those kind of questions a fair amount. It's not, so we absolutely get the producer license in the primary state first. But additional states it's just pushing some paper. There's no tests involved. So getting somebody licensed in the initial state, there is a prep class and a test they have to sit for. But after that, it's literally pushing paper. The only caveat that I have to lots of states is you got to do significant business in those states, because we go to all of our insurance carriers and we say, hey, Ryan Grant's team in California, we're going to expand into Utah and Colorado and Arizona. And our carrier partners are good with that, as long as it's not going to be like a policy here and there. It's going to be, hopefully a couple policies a month at least. So I've never really put a number on it, but as long as you're doing, a significant amount of business for you in multiple states, we can get your producer license in as many states as we need to.
And then circling back to the question previously, so Mike was saying, so Rich, how would you do it? Like if he wanted to start an insurance business and say it's himself, 2 loan officers, and another insurance agent who's also a producer who also has a book of business, would that be a good idea to bring that insurance agent in as kind of a collective owner as well?
Yeah, there's no reason why you can't do that. You have 100% of equity to play with. So you would decide if that person is, 5% or 10%, or maybe they're 55%. Totally up to you. And I would, if it were my business, I would just look pretty carefully at the amount of business they're going to bring with them, or roughly what they're going to bring with you. And you can model that. I'm happy to help work the numbers with you, but I think that's a reasonable idea.
Yeah, I like that. And then to answer your question, Wade, yes, the loan officer does not need to get licensed, anything like that. You don't need to get trained. This is a completely separate insurance professional, the same way that you would refer to your State Farm professional in your market that you might refer to now. You're just referring to a different insurance agent who works for your insurance practice. And yes, you can definitely recommend a potential hire for the insurance rep. They would absolutely love that, and they'll vet them out. They'll give you feedback and let you know if it would be a good person or not. I don't know about you guys. I didn't know much about what it would, what a good insurance rep would be like. And so I leaned pretty heavily on Comma to find our insurance reps, and they did a great job there. But if you have a referral, I'm sure they'd love one. Albert is asking the layout of the blueprint of the business structure. So Comma Insurance is the name of the insurance company that the client would see and the client would deal with, and that would be kind of your insurance agent, and you would just own the how would you call it, Rich? Like ours is, we have a separate insurance services name for our holding group, but it's under Comma. How does that layout work?
Yeah. So essentially, you tell us what the LLC name is the owners want us to build it for you, and then we file the LLC, and that LLC owns the branch. It owns the local insurance agency, and you own the book of business. It's all yours. We are literally your operating partner. So it's much like a franchise. Legally, it's not a franchise, but it looks a lot like it. And frankly, we use that term, to describe it. But that's exactly right, Ryan.
Got it. And then a question here says, Mike's asking, how do you deal with multiple owners who are all doing different levels of production, i.e. maybe one LO has a horrible year, but equitable ownership. So Mike, that's, by the letter of the law, you're not supposed to say, all right, well, you do X number of loans, so you get this percentage. Now, in reality, that's kind of how you look at it. Like who's going to be contributing to this and in what manner, and how much do you want to buy in for? So when looking at multiple owners, you all have to agree that, essentially, you're going to take this much equity in the business, and for whatever reason, right? Whether it's the startup cost, whether it's the contribution, whether it's the fact that you brought the opportunity to the table, there could be all sorts of different negotiating points as to who owns how much equity. You just can't really move it around once you started it based upon production, right? And this is where you want to get real clear that, we have monthly meetings with our group, right? We look at the numbers, we review everything, we figure out who needs help, who needs training, who needs to add it and get better in making it a part of their process. So that's the challenge, right? Is you just have to find people that are in it for the long haul, and everybody's like-minded, and just like anything else, right? Having a business partner in any venture is a bit of a risk. You just have to work through it and make sure you're happy with who you're working with. Mike's asking, if we buy in via an LLC, my LLC would be part owner of this LLC versus me directly. Do we need an ABA? Yeah, I think so. Rich, how would that work? I mean, if someone has an LLC, could they buy into the corporation?
Yeah, they can. We err on the side of caution, and we always want an ABA signed, whether, by the letter of the law, you should have one or not. So we always encourage it. That's really the answer.
Got it. And so a question here, what happens if I want to be 100% owner, but don't close 250 loans per year yet? Well, you're Art of Homeowners, your partner, Wade, so you will soon. But yeah, how would that work, Rich? Would it kind of be a non-starter, or?
No, I mean, look, let me show you here. Everybody sees the screen still. Let me go over here, and excuse me, I move that. Let me change this number from 40 to 20. So let's say you're doing 20 a month consistently now. And once again, this model doesn't, you could build in 2 models and change the number. But if you do 20, you see what happens.
20 a month would be 240 though. That's pretty much close to that number.
All right, well, let's lower
maybe
it.
Change it to 10.
All right, let's lower it to 10. Oops, wrong number. So let's go over here and see what 10 does. So you put in 80 grand at the end of year 1, you're down 70. So we made back 10 grand. Year 2, we made all of it back, but 8 grand. So, in year 3, you get a distribution of 3 grand. You just see that in 5 years, you've made back essentially your original investment. Yeah, you've got an asset now that you could sell for $400,000. There's no reason why it doesn't work. But remember, you've got this producer that you'd like to keep busy. And it takes about 5 referrals a week to keep a producer appropriately busy, and 10 a week keeps them really busy. So that's the reason we don't encourage lower numbers. I mean, we can do it. It's just, you're not going to make great money for a few years.
Yeah, but I think if someone was so inclined and they're doing 10 loans a month and they're looking at this, they're like, hey, I'm okay if, in year 3, I have a $230,000 asset and I'm, I really kind of break even. But I think the key point that Rich touched on is finding someone who you can keep employed off of, 2.5 referrals per week. And, that insurance professional needs to make money and need to, feed their family and see growth and all that stuff. That's why having that higher number is probably going, because if you have turnover in that role, or, you just, that person leaves, you got to find somebody new, it's going to slow you down and be a bit of a challenge. So you want to find someone who can really, take on a good amount of business out of the gate.
Exactly.
Another question here from a lending disclosure. I'm assuming you have to do an affiliated, but yeah. So Pinky, you may not have been on the first part of the call, but that is correct. And we just let them know, we have an ownership interest in this, so we have an affiliation with this company. But here's all the reasons why all of our clients use them. Here's why we use them, so on and so forth.
Hey Ryan, I have one comment I'd like to make.
Yeah.
We mentioned it. We forgot to mention it earlier. For anybody who's interested, our business has been approved by the SBA for what's called an express loan. And if somebody looks at this and says, you know what, I'm a little cash strapped now, or a lot of people look at this and go, you know what, I've got 80 grand, but I'd rather invest it in, GameStop stock or something like that. The SBA has pre-approved this for up to a 90% financing at low interest rates. Everything's low interest these days. So if somebody is interested, or people are interested, instead of $80,000, it could be $8,000, and the business would cash flow and pay back the SBA loan for you. So we also have that option for financing if people are interested in that.
That's a good point. All right, gang. Well, I think, hold on. We got a couple more questions here. If I really don't want an ABA, does listing my wife as an owner, not me, solve that? So if the spouse is an owner, do they still need an ABA or no?
Well, as I said, so we recommend one. You don't have to. We actually build one and provide that. And if they say, you know what, we're just not going to have anybody sign it because my spouse owns it, then that's fine. I've seen another situation where loan officer, just had an outside entity own it, and technically there was no need for an ABA. So you can get around it.
Yeah, I think it's just more of a risk thing on your side, Mike. So, if the client ever says, hey, well, it looks like, your wife owns this company and that wasn't, disclosed to me, and they could still, anyone could sue for anything, right? And so it's just a matter of, how much risk you want to contend with on your side. But technically, letter of the law, if you don't own it, you don't need an ABA. But somebody could then come back and say, well, even though it's not you, it's your wife, and we should have known that. So it's really just a matter of risk.
Right. Yeah. Let me comment one more point on that. So as I said earlier, we have loan officers that say, hey, I can't put this in my doc stack at work. My mortgage company or bank or whatever won't let me do that. We're fine with that. Remember, I said that the producer, we require our producers to capture the ABA if their branch owner is an owner on every loan. I'm sorry, on every insurance policy. So I'm not sure if that's what Mike was getting at, going, hey, I literally can't capture an ABA. That's fine. We're going to get it on the insurance side for you.
He could. Yeah. I mean, I know his company, he could. We did. So we were there. So it's acceptable. Another question here. Why can't we have higher expectations for the producer, meaning to create their own business and keep themselves busy? You definitely can. The question is, do you want to? Right. I mean, so everything we're modeling here is based off of kind of what we see as averages, right? And so this is all very conservative. If you find a rock star producer that, goes and gets their own business and keeps themselves busy, then, that producer likely is going to want a bigger piece of the pie if the majority of their revenue is coming from them. Whereas, if 80% of their business is coming from us as the originators or the realtors, and they only have to go get 20, then, they'll be okay being paid accordingly. So there's no, you can expect whatever you like, and you can ask your producer to do whatever you like. But, when we're modeling this out, this is kind of the averages that we're seeing here.
I can throw one or two more comments in on that. So
sure.
Yeah, if you're pushing, 20 plus referrals a month to your producer, they're pretty busy. Now they're going to have time, and we train them and coach them and manage them to go out and develop relationships outside of your referrals. We don't want them sitting there all week, every week, just working your referrals. And where you're headed is actually correct. So they get paid a higher commission on business that they go out and source themselves. And what happens is once they get 10 or 20% from outside sources, they look at their paycheck and they go, hey, I'm having to work less making more money with this outside business. I like this. So then that 20% becomes 30 or 40%. And that's dynamite for your branch, because then it's time to go hire your second producer, and the cycle starts over. They kind of start out at 100% with your referrals, and then they get 10% and 20% from outside sources, and they see their pay is growing significantly. And that's how we have a branch that has 4 producers right now. For that reason exactly. Those 4 producers have gone out and gotten a chunk of their own business from outside sources, and we just keep adding and growing that branch office. So it can happen. Once they sort of get addicted to that higher level of commission, then it's really growing your branch nicely.
Yeah, that's perfect. That's a great idea. All right, and then last question here, just because I know we got to wrap it up, but so it sounds like there's constant reporting and it breaks down origination source. Yes, that's correct. You'll get weekly reports on how many deals have been referred in, how many are pending, how many are waiting for the client to say yes, how many said no, how many wins you had. So every week you get a full report of who referred the business in and the status of it and kind of what happened to it. And so it really helps from a training perspective and accountability perspective, just to make sure that everybody's kind of on the same page there. So, all right, guys. So with the last couple minutes here, if you would like to schedule some time with Rich, what would be the best way for them to connect with you to get more of a personalized exposure to this and more kind of maybe like a pro forma based upon their business and Q&A session?
Yeah. If you're interested in kicking the tires, I'd love to have a conversation with you. My email is rich.schultz@insurance.com. I can send that out, or Ryan, I don't know how we can do that through AOH, but happy to do that. And
did I just spell it right? Can you take a look at that in the chat?
That's it. Good job. So there you go, folks. Yeah, shoot me a note. We'll set something up. We'll walk through it together. And the sales cycle is, I've had one convert in 2 days, and some of them take 6 months. Some people add, loan officer partners early on. Some of them add them after the branch is up and running and the value of the branch grows. So happy to chat with you and walk you through that and answer any questions you might have.
Perfect. Well, everybody, thank you for your time today. That went longer than I expected. I thought it was going to be maybe half an hour or so, but hopefully you guys learned a lot about it. It would be amazing for you guys to have your insurance practices, especially as an Art of Homeownership partner, just to add yet another value add to all the things that you do, plus just a great long-term revenue and growing asset. So thank you for your time today. Hopefully this was helpful. And if you guys have any questions, always email support@artofhomeownership, or feel free to email Rich at rich.schultz@commainsurance.com, which is in the chat there. And hopefully you guys get your insurance practice up and running. Thanks, Rich. Appreciate it, everyone.
Thanks, team.
Talk soon.